Hello, astute investors, and welcome back to the Dividend Uncle, your trusted guide in the world of dividends and investments. In today's exploration, we're stepping beyond the familiar shores of Singapore to explore an enticing opportunity in the vibrant landscape of Hong Kong. Now, you might be wondering, why should investors of Singapore-listed REITs consider the allure of a Hong Kong-listed gem like Link Real Estate Investment Trust, or Link REIT? Well, the answer lies in the unique proposition it brings: diversification into the dynamic Hong Kong properties market, a facet that no Singapore-listed REITs can currently offer. Before I start, I wanted to take the opportunity to introduce my collaboration with Webull. If you are thinking of setting up a low-cost brokerage account, go for Webull for easy-to-get freebies. Use my exclusive link in the description section, and you'll get to win 10 free shares, worth up to $5,000. Just fund your account for 30 days, any amount. Additionally, there's also a Moneyball promotion where you can earn up to $2,000 by funding more. Lastly, Webull recently launched their very first shares transfer deal. More details can be found in the description. My wife has already signed up. Okay, without further ado, let's get started. Link REIT is a portfolio diversifier. Link REIT isn't your run-of-the-mill real estate investment trust. It made history as the world's first publicly listed REIT, debuting on the Hong Kong Stock Exchange in 2005. With an extensive portfolio spanning shopping centers, office, and car park properties, Link REIT has become a juggernaut in Hong Kong's real estate scene. It is Asia's biggest REIT with 238 billion Hong Kong dollars portfolio value. This is about 40 billion Singapore dollars. As a comparison, CapitaLand Integrated Commercial Trust, which is Singapore's largest REIT, has a portfolio value of about 24 billion Singapore dollars. 1. Performance snapshot as at Q3 2023. Let's dive into the intricacies of Link REIT's recent performance. In the last reported quarter, Link REIT showcased robust financials, with a noteworthy year-on-year increase in net property income by 10.4%. The strategic diversification across retail, office, and car parks played a pivotal role in this resilience. Despite challenging market conditions, Link REIT's occupancy rates held steady at 98.0% for Hong Kong retail, and rental reversion of 8.7%, a testament to its strategic property management. 2. Distribution per unit and dividend outlook. Let's talk numbers, specifically, the distribution per unit, or DPU. Link REIT has a track record of delivering steady dividends to its unit holders, with compounded annual growth rate of 9.6% since IPO in 2005. While past performance doesn't guarantee future results, the REIT's commitment to a sustainable distribution policy provides a sense of stability. Keep in mind that Hong Kong's property market dynamics and Link REIT's strategic management can influence the dividend outlook. 3. Diversification benefits. Now, why should you consider diversifying your REIT holdings to include Link REIT? The answer lies in the advantages of geographical diversification. While Singapore offers stability, venturing into Hong Kong introduces a new dimension of growth potential. Hong Kong's position as a global financial hub and its resilience in the face of economic challenges make it an intriguing market for real estate investments. While the COVID crisis has negatively impacted Hong Kong's economy, analysts are expecting Chinese tourists to help boost property sectors like retail and hospitality. As for office, Hong Kong is similar to Singapore with trend towards returning to office. 4. Risks and considerations. No investment is without risks, and Link REIT is no exception. Hong Kong's property market can be sensitive to global economic shifts and local geopolitical developments. China's economic slowdown can have an impact in Link REIT. Additionally, factors like interest rates and regulatory changes can impact property values and rental yields. It's crucial for investors to conduct thorough due diligence and consider these factors when evaluating the suitability of Link REIT for their portfolios. Now, let's draw a comparison with Mapletree Pan-Asia Commercial Trust, or MPACT, a notable Singapore-listed REIT with exposure to the Hong Kong property market, and whether we can substitute it for Link REIT to diversify to Hong Kong. 1. Exposure to Hong Kong. Mapletree Pan-Asia Commercial Trust, with its Festival Walk property in Hong Kong, accounts for a smaller portion of its portfolio value. Festival Walk, a retail and office complex in Kowloon Tong, contributes 26% of Mapletree Pan-Asia Commercial Trust's portfolio value as of March 31, 2023. The property has a valuation of 4.3 billion Singapore dollars. However, this is dwarfed by Link REIT's Hong Kong properties, which accounts for about 75% of its property portfolio and are valued at 30 billion Singapore dollars. 2. Examining key metrics. As of the latest available data, Mapletree Pan-Asia Commercial Trust offers a higher dividend yield of 7.9%, but has a higher price to net asset value ratio of 0.79 and higher gearing ratio of 40.7%. Compared to Link REIT's dividend yield of 6.2%, a price to net asset value ratio of 0.57 and much lower gearing ratio of only 18.0%. In fact, Link REIT's gearing ratio is lower than any Singapore-listed REITs. The Dividend Uncle's take on diversification benefits in comparison with MPACT. Diversifying to Hong Kong may be beneficial for an investment portfolio that is more focused in Singapore. Other than interest rate increases, Hong Kong's retail and office sectors have been affected social unrest. As a result, Link REIT declined by about 30% year to date. Looking ahead to the Hong Kong property market in 2024, the outlook suggests a measured yet steady recovery, contingent on factors like the border reopening and government policy support. Link REIT, with its huge properties exposure across Hong Kong, and excellent reputation of shrewd management, is a good starter choice. While Link REIT will potentially benefit from the recovery, we should be aware of risks if the recovery is delayed or disrupted. In terms of comparing with Mapletree Pan-Asia Commercial Trust, I think Link REIT and MPACT present distinct strengths and weaknesses, but in my views, Link REIT is a more obvious choice for me to diversify to Hong Kong. Link REIT has a larger and diversified exposure to Hong Kong, an extremely low gearing ratio for a REIT, and hence less impacted by higher interest rates, and cheaper share price valuation. As we conclude this exploration, remember that every investment decision should align with your financial goals and risk tolerance. If you found this comparative analysis insightful, do give it a thumbs up, share it with fellow investors, and subscribe for more in-depth dives into the world of dividends and investments. Stay connected with us on Instagram for bite-sized insights and behind-the-scenes content. Until next time, happy investing in the diverse world of REITs.